A 71-year-old woman in Pennsylvania lost her husband and believed that, at least financially, things were simple. They had been married for decades, they bought their home together more than 30 years ago, the mortgage had long since been paid off, every major asset was titled jointly, their bank accounts carried both names, the house deed listed both spouses. There were no complicated business holdings, no exotic investments, no obvious red flags. After the funeral, she did what many surviving spouses do. She stayed put. She did not sell the home. She did not transfer large sums of money. She did not restructure accounts. She simply continued living in the house they had shared since 1990. 9 months later, a letter arrived from the IRS. The notice referenced a filing requirement related to her husband's estate. It mentioned a federal estate tax return. It cited deadlines. It referred to something called portability and unused exemption amounts. She had never heard of Form 706. No one at the hospital had mentioned it. No one at the funeral home had mentioned it. When she visited the bank to remove her husband's name from their checking account, no one there brought it up. Her adult children had no idea such a filing even existed. By the time she hired a professional to untangle the situation, she had already missed important deadlines. She paid $6,200 in professional fees to address issues that could have been handled early with minimal cost. She missed a state-level inheritance tax deadline, and more significantly, she failed to make a federal portability election that would have preserved her husband's unused estate tax exemption, an exemption that could have shielded more than $13 million in combined family assets in the future. 3 forms and 1 phone call within the first 60 days after her husband's death could have prevented all of it. There is something many people do not realize. When a spouse dies, the IRS does not pause. Grief does not extend deadlines. Confusion does not stop the clock. On the date of death, a countdown begins. In most cases, you have 9 months to make certain decisions and filings. What you do, or fail to do, during that 9-month window can determine whether your family keeps the wealth you built together or loses part of it to taxes, penalties, and unnecessary legal costs. This discussion is for educational purposes only. It is not tax advice, financial advice, or legal advice. Every situation is different. Before making decisions about your own circumstances, consult a qualified CPA, tax attorney, or estate planning professional. What follows is a breakdown of what that 9-month period means, why surviving spouses who own homes are especially vulnerable, and the 5 practical steps that can protect you from expensive mistakes. First, understand why surviving spouses are uniquely exposed to financial missteps after a death. When one spouse dies, the IRS treats the event as a taxable moment, not because anyone sold property or generated income, but because ownership interests transfer. Even when everything passes to the surviving spouse, the legal structure changes. Assets must be valued as of the date of death. Certain elections must be made. Decisions that seem administrative can have enormous long-term tax consequences. Most married couples own their primary residence jointly. They assume that when one spouse dies, the other automatically becomes the sole owner and that nothing further needs to be done. In many practical ways, that is true. But from a tax and legal standpoint, several critical steps still need attention. There are 3 major sources of financial risk after a spouse's death. The first is the federal government. Even if no estate tax is owed, certain filings may be required or strategically advisable within 9 months. The second is your state government. Some states impose estate or inheritance taxes with thresholds far lower than the federal exemption. In a few states, inheritance tax applies from the first dollar. The third source of risk is unintentional error. A missed appraisal, an outdated beneficiary form, or a deed left unchanged can trigger unnecessary capital gains taxes, title problems, or lost exemptions years down the road. There are 5 core steps that protect the surviving spouse from these risks. Most of them cost little or nothing. Most can be completed within weeks, and the financial difference between handling them promptly and ignoring them can reach 6 figures. Step 1. Obtain a date of death appraisal for your home. When your spouse dies, the tax basis of certain assets is adjusted to their fair market value as of the date of death. This adjustment is commonly called a stepped-up basis. It is one of the most powerful and least understood tax protections in the Internal Revenue Code. To understand why this matters, consider a simple example. Suppose you and your spouse purchased your home in 1995 for $120,000. Over the decades, the neighborhood improved, property values rose, and by the time of your spouse's death, the home was worth $450,000. If no basis adjustment applied, and you later sold the home for $460,000, the IRS could calculate your gain starting from the original $120,000 purchase price. That would produce $340,000 in capital gain. Even after accounting for the $250,000 primary residence exclusion available to single taxpayers, a significant portion could remain taxable depending on the circumstances. With a stepped-up basis, however, the property's tax basis resets to its fair market value at the date of death. In this example, $450,000. If you sold the home the following year for $460,000, your taxable gain would be only $10,000. The difference between those two calculations can mean tens of thousands of dollars in tax savings. But there is a crucial requirement: documentation. The IRS expects you to substantiate the home's fair market value at the date of death. The best way to do that is with a formal appraisal conducted by a licensed appraiser as close to the date of death as possible. If you wait 3 or 5 years and then try to reconstruct what the home was worth at the time of death, you may struggle to prove it. Real estate markets change. Comparable sales data disappears. Memories fade. Without solid documentation, you weaken your position if the IRS questions your reported basis. Professional estate planners routinely order a date of death appraisal within weeks of a client's passing. For many middle-class families, no one suggests it. Yet the cost, often between $300 and $500, can protect against 5-figure or even 6-figure tax exposure in the future. Ideally, this appraisal should be completed within 60 days of the death. Step 2. Determine whether to file Federal Estate Tax Form 706 and make a portability election. This is the heart of the 9-month window. Form 706 is the federal estate tax return. It is generally due 9 months after the date of death. For 2026, the federal estate tax exemption is approximately $13.99 million per person, though this figure is subject to change with legislation. Most estates fall well below that threshold. As a result, surviving spouses often assume that no filing is necessary. They believe estate tax only applies to ultra-wealthy families. They assume there is nothing to report. That assumption can permanently erase a valuable tax benefit. When one spouse dies, any unused portion of their federal estate tax exemption does not automatically transfer to the surviving spouse. To preserve that unused exemption, the executor must file Form 706 and elect portability. Portability allows the surviving spouse to add the deceased spouse's unused exemption to their own. In effect, a married couple can potentially shield nearly double the individual exemption amount, potentially approaching $28 million under current thresholds. If Form 706 is not filed and portability is not elected within the allowed time frame, the deceased spouse's unused exemption is lost forever. Some families assume that they will never accumulate assets anywhere near those levels, but circumstances change. Home values rise, retirement accounts grow, life insurance payouts increase net worth. Legislation can lower exemption amounts in the future. A family that appears comfortably below the threshold today may exceed it 10 or 20 years from now. Wealthy families almost always file Form 706 at first death, even if no estate tax is owed, specifically to preserve portability. Many middle-income families are unaware that this option exists. Within 30 days of a spouse's death, a surviving spouse or executor should consult a CPA or estate attorney to determine whether filing Form 706 makes sense. If required or advisable, it must generally be filed within 9 months of the date of death. Extensions may be available, but relying on them introduces complexity and risk. Filing when no tax is due is not about writing a check to the IRS. It is about protecting future flexibility. Step 3. Update the deed and property title. After a spouse dies, their name often remains on the deed. Even if ownership passes automatically through joint tenancy or tenancy by the entirety, public records still reflect two owners, one living and one deceased. Years may pass without issue, but when the surviving spouse attempts to sell, refinance, or transfer the property into a trust, title complications can arise. The presence of a deceased owner on record may require affidavits, certified death certificates, or even court involvement to clear. In most counties, updating the deed is straightforward. The surviving spouse files a certified copy of the death certificate along with an affidavit of survivorship or executes a new deed reflecting sole ownership, depending on state law. Filing fees are typically modest. One common fear is that updating the deed will trigger a property tax reassessment. In many states, transferring property to a surviving spouse does not cause reassessment. Nonetheless, local rules vary, so it is wise to confirm with the county recorder or assessor's office. Estate planning attorneys handling higher net worth estates typically address title updates within weeks. For others, the issue lingers unnoticed until a transaction forces attention, often at greater expense. Completing this step within 30 to 60 days reduces the risk of future delays and legal costs. Before moving to the next step, consider state-level estate or inheritance taxes. While the federal exemption is high, several states impose their own estate or inheritance taxes with significantly lower thresholds. In some states, estate tax applies once assets exceed $1 million. In others, inheritance tax is imposed on beneficiaries at varying rates, sometimes starting from the first dollar inherited. For example, Pennsylvania imposes inheritance tax with different rates depending on the relationship between the decedent and the beneficiary. Other states have similar systems. Deadlines for state filings may differ from federal deadlines. Some states require filings sooner than 9 months. Interest and penalties can accrue quickly. A surviving spouse should review their state's estate or inheritance tax rules within the first month after death. Do not assume that federal non-liability means state non-liability. Step 4. Review and update all beneficiary designations. Many assets do not pass through a will. Instead, they transfer by beneficiary designation. Examples include life insurance policies, IRAs, 401k plans, annuities, and certain bank accounts marked payable on death or transfer on death. These designations override the will. The financial institution will distribute the asset to the person listed on the form, regardless of contrary instructions in estate documents. If a life insurance policy intended to cover final expenses still lists an ex-spouse or a deceased parent as beneficiary, that money will not automatically redirect to the surviving spouse. Correcting such errors after death can require litigation. Within 30 days of a spouse's death, the surviving spouse should contact every financial institution and request confirmation of current beneficiary designations. Any form naming the deceased spouse should be updated to reflect new intentions. This process may require submitting a death certificate and completing updated forms. Though it can feel administrative, it is essential. An afternoon of calls and paperwork can prevent assets from being misdirected. Step 5. Apply for surviving spouse property tax benefits. Many states and local governments offer property tax relief programs for seniors and surviving spouses. These may include exemptions, valuation freezes, homestead protections, or income-based reductions. In some jurisdictions, if the deceased spouse had qualified for a senior exemption, the surviving spouse can continue receiving the benefit even if they do not meet age thresholds themselves. In others, surviving spouses may qualify for enhanced homestead protections. These programs are not always automatic. Applications may be required annually or upon change in status. Deadlines can be early in the calendar year. If a spouse dies early in the year and the surviving spouse fails to apply before the deadline, they may overpay property taxes for the entire year. Over time, missed exemptions can add up to thousands of dollars. Within 30 days of the death, contact the county assessor's office. Ask specifically about programs for surviving spouses. Request written information. Mark application deadlines on your calendar. Now consider the broader picture. All 5 of these steps fit within the first 9 months after death. Most should occur within the first 30 to 60 days. None require extraordinary wealth. None require advanced financial sophistication. They require awareness and timely action. The checklist is straightforward. Obtain a formal date of death appraisal for the home within 60 days. Consult a qualified professional within 30 days to determine whether Form 706 should be filed and whether portability should be elected. File within 9 months if appropriate. Update the deed to reflect sole ownership within 30 to 60 days. Audit and update all beneficiary designations within 30 days. Apply for any available surviving spouse property tax exemptions before applicable state deadlines. The widow in Pennsylvania did not neglect these steps out of irresponsibility. She simply did not know they existed. No one told her that the IRS clock began immediately. No one explained portability. No one suggested an appraisal. Her experience is not unusual. When a spouse dies, the emotional burden is immense. Paperwork feels secondary. Yet certain actions, taken calmly and deliberately within the first months, can protect a lifetime of work. The difference between preserving wealth and losing part of it is often not income level, it is information. If you or someone you know is navigating the loss of a spouse, share this knowledge promptly. Encourage early consultation with qualified professionals. Make a written checklist. Mark deadlines clearly. Grief is unavoidable. Financial damage from missed filings and overlooked elections often is not. And remember, laws change. Exemption amounts change. State rules vary. Always confirm current regulations with a professional in your jurisdiction. The 9-month window does not wait. But with awareness and action, it can be managed.